Hello, everyone, and welcome back to another temporary lecture. In this one, I wanted to talk about real SMTs. So, as you previously learned what SMTs are and when to use them within market maker models, now I want to introduce what actually constitutes as a real SMT to me and is highest probability. So, there are three things that are a factor in a real SMT. One is you need to use a time-based liquidity. Two is you need to have stacked SMTs. And three is you need a volatility injection. And so let's break down all three of these things. So one is a time-based liquidity. In order to find your time-based liquidities, as previously mentioned in quarterly theory, we split our times into 4 equal sections based on a specific defined range in time. So that could be your daily candle, your weekly candle, your monthly candle, right? And that's where we get the yearly cycle from. So the yearly cycle is using the yearly candle and breaking up into 4 sections. The monthly cycle is breaking up the monthly candle into 4 equal sections. The weekly cycle is breaking up the weekly candle into 4 equal sections, which is, well, it's actually not equal because it's Monday, Tuesday, Wednesday, Thursday, and then Friday, you just ignore it. And then the daily cycle, you're splitting up into 4, which is an Asian session, London session, New York AM session, and New York PM session. So I'm sure you get the gist. So whenever looking for a time-based liquidity, you're going to be looking for the high and low of every cycle. So let me just quickly draw out some PA here, right? So let's say you had price action like this, then you're just referring to every single high and low of every quarter. So let me just break it down here really quickly. And so you have Q1, Q2, Q3, Q4. Whichever current quarter you are in, you are always going to be referring to the quarter that occurs directly before the current quarter. So if you're in Q2, then you're referring to the high and low of Q1, right? So you can just mark that out. Let's just say this is the low. If you're in Q3, then you're referring to the high and low of Q2. If you're in Q4, then you're referring to the high and low of Q3. And it's really that simple. So that's the first part of it, time-based liquidity. So why is it called time-based liquidity? It's called time-based liquidity because the high and low of each quarter refers to a specific time-based liquidity, which is a defined range in time where paying attention to the sectioned out time, the high and low. And so here I've pretty much listed out why we refer to these points. And so here you can see on the left, I've put the cycle, and on the right, I've put each quarter's time-based highs and lows. So starting with the yearly cycle, that's splitting up your yearly candle into quarters. So that would be your previous seasonal highs and lows. So that'd be your winter high and low, your spring high and low, your summer high and low, and then you also have your fall high and low. And then for the seasonal cycle, you're breaking up a 3-month candle into quarters, which is going to be your previous month highs and lows you're referring to. And then your monthly cycle, you're bringing up your monthly candle into quarters. And so that would give you your previous week's highs and lows. And then for the weekly cycle, you're breaking up your weekly candle, which gives you previous day highs and lows. Once again, you're referring to Monday, Tuesday, Wednesday, Thursday. Friday, you're just counting it as distortion. And then your daily candle, which you're splitting into 4 sections for your previous session highs and lows, your Asian session, London session, New York AM session, and New York PM session. And then you have your session cycle, which is going to be your previous 90-minute highs and lows. And then last but not least, you have your micro session cycle, where you're breaking apart that 90-minute candle into 4 quarters of itself, which is going to be your previous microcycle highs and lows. And so that is why it is called time-based liquidity. And so I hope that puts into perspective why we use the specific time frames we do for each cycle now, because it makes a lot more sense once you break it down into the liquidity pools we are referring to, right? So for example, on the monthly cycle, just to make it a little simpler, for the monthly cycle, the time frame alignment we use is 4-hour chart for the monthly cycle. And if you were previously confused, why do we use 4-hour chart with the monthly cycle? It's because we're referring to the previous week highs and lows. And so that previous week high and low, that is a weekly liquidity pool. And so that's why we use weekly liquidity pool is our key level, which means we use the 4-hour chart as our time frame alignment. Same as the weekly cycle, we're using our previous day highs and lows. And so if we're using a daily liquidity pool, then we're going to be using our 1 hour as our time frame alignment, right? And so now it suddenly makes a lot more sense. And once again, for the daily cycle, if we're paying attention to the session highs and lows, then the 15-minute chart works the best for that. It is technically breaking up the 6-hour candles liquidity pools. However, we just use the 15-minute chart to refer to that. You can also use the 30-minute chart for the daily cycle, but personally, I would recommend using the 15-minute chart for the daily cycle because that is just higher accuracy in my opinion, and it's the perfect intraday time frame. And so I hope that makes a lot more sense of why we use those time frames. The second thing that makes an SMT real to me is when there is stacked SMTs. And so what that means is you have a higher time frame SMT on top of a lower time frame SMT. And so here, let's say you had an SMT on the higher time frame, and then you had another SMT on the lower time frame, right? So I'll just make the second price line a different color so you can tell that this is the lower time frame price action. So a higher time frame SMT plus a lower time frame SMT. And so that is stacked SMT. And whenever you have stacked SMT, this becomes extremely high probability. And you may ask, what is a valid stacked SMT? And so now I've actually listed out the higher time frame SMT to lower time frame SMT, as well as added some quarters for the annotations here just for clarity for you guys. So continuing with my example, if you were to get a yearly cycle SMT, then you would refer to a seasonal cycle SMT. So for example, you see these big quarters here. These would refer to your yearly cycle SMT. And let's say you had SMT between 2 quarters. Then you would refer to the seasonal cycle and look for an SMT on that time frame as well. And once you have a higher time frame SMT to a lower time frame SMT, that's going to be your high probability SMT. If you had a seasonal cycle SMT, which are the big quarters once again, then you would refer to the monthly cycle SMT, which is the small quarters. If you were to have the monthly cycle SMTs as your higher time frame, which are once again the big quarters, then you would be referring to the weekly cycle SMT as the lower time frame SMT. And so, it goes on. So if you're using a daily cycle SMT, then you're referring to a session cycle SMT. You're using a session cycle SMT as the higher time frame, then you're looking for a micro session cycle as a lower time frame. So it's pretty straightforward. Whichever higher time frame cycle your SMT occurs on, then you're going to refer to this cycle directly below that. And so if I were to break it down into time frame wise, it would be a weekly SMT becomes confirmed by a daily SMT. A daily SMT gets confirmed by a 4-hour SMT. A 4-hour SMT gets confirmed by a 1-hour SMT. A 1-hour SMT gets confirmed by a 15-minute SMT. A 15-minute SMT gets confirmed by a 5-minute SMT. And a 5-minute SMT gets confirmed by a 1-minute SMT. And so that's how we're going to be looking at our SMTs. Is 1, it has to be time-based, and 2, it has to be stacked SMTs. Number 3 is somewhat optional. In my opinion, I think that as long as you have a higher time frame SMT to lower time frame SMT, in my experience, that's already extremely high probability. However, if you have a volatility injection creating one of these SMTs, that'll make it even higher probability. And once again, your volatility injection is just any red folder news event or equities open in terms of index futures. So that'd be 9:30 a.m. Usually you'll see 9:30 a.m. creates some sort of SMT and you'll look for that trade specifically. Or if you see a red folder news event that creates SMT, then you'll be looking for that trade specifically once again. And so for news events or volatility injection, Typically, what I found in my own backtesting is that orange folders will usually create a daily cycle or lower SMT. The red folders will usually create a weekly cycle or lower SMT. And then you'll have the big three, such as CPI, FOMC, and NFP, which are extremely volatile news events. They usually create a monthly cycle or lower SMT. So, this is a pretty good general rule of thumb to be on the lookout for. And it's usually pretty accurate. So I would backtest that if I were you. I actually highly suggest you backtest this because this is going to go into the complete model of what I like to trade. So you need to understand this very in depth. So that's all for this lecture. Once again, real SMTs. What are the three things that make them up? Is one, time-based liquidity, the high and low of every quarter that is prior to the one you're trading in right now. So if you have SMT with the high or low of that, then that's what you're looking for, right? Two is stacked SMTs. So stacked SMT, higher time frame cycle SMT to a lower time frame cycle SMT. And then number three is volatility injection. And as I have it written out right in front of you guys here, orange folder, you usually look for either a daily cycle or lower SMT. A red folder, you look for a weekly cycle or lower SMT. And then one of the big threes, you're usually looking for a monthly cycle or lower SMT. So, on that note, I hope you guys found this insightful. And as always, have a great day.